good evening, everyone. So I'm going to share my screen to take you through a bit of the conceptualization of this problem. A bit of context behind it would be working in retail banking. There is a lot of revenue leakage due to customers becoming delinquent on loan or mortgage payments, as well as the bank rejecting customers because they didn't meet a certain criteria, or even the customer rejecting the bank simply because they were offered more competitive rates, for example. So the problem I'm going to attempt to solve theoretically and hopefully in application is ways on optimizing this, right? So that's a bit of the context. So I'm going to share my screen. You guys could let me know when you're seeing my screen.
Yes, we could see.
We're seeing a word.
All right, awesome. Yeah, so I kind of just drafted together the problem in this document. This is something Prof and I have been talking about for a couple of weeks now. We are in the data acquisition phase. So this is what I'm going to walk you guys through tonight. So as mentioned before, in retail banking, there is a lot of revenue loss, and I will be using my mouths just to kind of hover over words, right? So bear with me on that. There's a lot of revenue loss within the credit portfolio, and by credit I mean within the loans and mortgages portfolio. So this loss of revenues can be due to customer delinquency, the bank's rejection of the customer, or the customer's rejection of the bank. And these unrealized revenue opportunities can amount to hundreds of thousands or even millions of dollars per year. So in addition to the lost revenues, banks can also lose customers, and as you would imagine, market share, which is really important for a bank to have stability, as well as they have to write these now delinquent customers off as bad debt. So in essence, the bank is losing money versus making money. And that in itself is like a huge collateral problem for the financial institution, right? So the approach that we are going to suggest involves a bit of what you would have highlighted before, Intamam, in terms of using predictive modeling and optimization and domain knowledge to help solve this problem, right? So I'm assuming we have some data set D containing loans customers. So in specific, let's just consider loans customers for now versus mortgages. And this data set will contain variables including customer level features such as age, gender, location, and those kinds of variables, income level, etc., which we will denote with F. Key loan variables of interest would include the loan amount, L, interest rates, I, and the length of the loan tenure, T. The dataset D will also contain the binary customer delinquency state, D, which basically is the customer's what the customer state of being delinquent or not being delinquent. And from this, we can use something like logistic, for example, on all the variables to come up with like a probability of delinquency that can be determined. So this will be denoted by P of D. The customer will also be in one of 4 payment states. The customers who were rejected because they were deemed by the bank to be too risky, and we'll call these customers N1. Customers who were offered a loan but declined the loan, we'll call these customers N2. Customers who accepted the loan but became delinquent, we'll call them N3. And customers who accepted the loan but did not become delinquent, N4. So these are pretty much the kinds of customers you want to attract, right? Your N4 customers. And each state would have like an associated idealized amount of revenues, which we will call EN1, EN2, EN3, EN4. So pretty much, if we didn't reject these customers who were not too risky, they would have given us EN1 in revenues, and customers who were offered a loan but declined, they would have given us EN2, and so on. So assuming an ideal world where the full revenues can be realized with no delinquency, then there would be no problem to solve. But even if the main loan parameters are adjusted, there may still be levels of delinquency. So meaning that you can still improve the delinquent state or the probability of delinquency to make somebody not delinquent, or they would still have a low possibility of becoming delinquent at some point. Like they can lose their jobs, for example. Maybe the pandemic was an ideal realization of, the job instability within organizations or industry, right? So to account for that, we would calculate R for each potential E of NI. So this R is like, the associated revenues with the probabilities of being defaulted. So I put down here what that would look like. So basically it's 1 minus the probability of default by the interest rates for the full amount, plus the probability of default multiplied by the delinquency by the interest rates up until the point of becoming delinquency minus the unpaid loans, right? So pretty much it's the sum of everything minus your unpaid loans, which is the delta. So this is what this seeks to calculate here. Based on that, this is hypothetically what the data set would look like. You would have your attributes A. Well, I called it A here, but it should be F. Loans L, interest rates I, tenure T, delinquency D, probability of delinquency P of D. Your payment states that I mentioned here can be N1 to N4. The return of revenue from the customer, R of E, which is what we just determined there, and the expected revenues, EN1 to EN4. So this would have been the full realized revenues. So this kind of gives us the ideal look or perspective of the customer. And so you can see here immediately, there's two approaches that we were looking at implementing to help maximize the revenues. The ultimate goal of this problem is to maximize revenues while being able to minimize delinquency. All right, so there's a probabilistic and a deterministic approach. The probabilistic approach includes training an ML model to predict the probability of delinquency, this field here. And then using this probability, we can adjust the key loan parameters, LI and T, these things here, to reduce the probability of delinquency. So just to give you context, if you have a very high probability of becoming delinquent, and I gave you a smaller loan with a smaller interest rate over a longer time, then your probability of delinquency should decrease, right? Because you are now able to manage that loan payment a lot better intuitively, right? And likewise, there could be a case where, I'm realizing that you have a low probability of delinquency, then I could probably increase your interest rate by a little bit, or actually offer you a larger loan amount without incurring too much of a risk to your probability of delinquency. And so I would therefore improve your return as a customer, right? So that's the probabilistic approach. The deterministic approach would be, we look at the expected revenues of all the customer cohorts that we will see by E. We will use E to calculate this expected revenues, and we'll take the rate of return, right? So this rate of return will be how much revenues we expect to receive from each cohort. N1, remember these N1 customers were too risky customers, so the bank turned them away. We would have no revenues realized from them. N2 would be the customers that we offered a loan to, but they declined the loan. So we can use our previous value of E to assume those expected revenues. The sum of the revenues achieved by N3, these are your customers who are who accepted the loan, but they became delinquent at some point. So they would have actually given some revenue contribution. And then the revenues actually achieved from the N4 customers, who are your good paying customers. And this rate would be, this divided by the total number of members in each cohort. From determining this expected rate or this rate of revenue return, if E is greater than 0, then it can be assumed that anyone with those attributes who are given a loan L and tenure T, and let's say we had given them an interest rate I equals 10%, then the expected return is E. So we can then repeat this for each value of E. And when we find each or compute each value of E, we can find an optimal value of I that maximizes E. So for example, suppose it is found that, and what is in here is the interest rate, right? So this expected return on an interest rate of 5 was 3%. The expected return on an interest rate of 10 was 8%. The rate of return for an interest rate of 15 was 7%, and 20 was 1%. So you can see that it kind of takes like a parabolic shape there, right? It goes up and then it comes back down, so it peaks. This quadratic then therefore shows that well, intuitively, again, you for a small interest rate I, you would expect revenues to be somewhat low, right? Here you can see our revenue rate of 3%. And when the interest rate is too high, you kind of increase the chance of that customer becoming delinquent, right? Because the amount that they would have to pay on a monthly basis contextually would be very high. All right, so the chances of them leaving are also high intuitively. So what we can do there, therefore, is like, use something like a least squares quadratic equation um, to determine the I that maximizes E. So like using this as a hypothetical example, we could have seen there that, it kind of peaks somewhat probably between an interest rate of 10 and 15. So let's say that was 11.9%. So therefore I know for that customer or for that group of customers, I can offer an interest rate of 11.9% and be able to yield maximum revenues. If it was too low, I wouldn't get much money. And if it was too high, I increase their probability to become delinquent, or I can also increase their chance of not taking the loan, right? So putting them in a different cohort. So these are the two methods, we are looking at exploring on optimizing the revenues from customers, one through a probabilistic approach, one more through a more deterministic approach that really looks at gaining as much money as possible, maximizing the benefit to the organization while minimizing the risk to the customer, as well as making things manageable as well, right? So it's kind of the balancing act between both worlds with those objectives in mind. So that brings me to the end of the discussion on the research that I will be conducting. Again, as I mentioned, I'm in the phase of acquiring the data to kind of support both of these two approaches. So yeah, that's it from me. Any questions on this?
Yeah, no, thanks for that, Kevin. I mean, I have no questions because we discuss this all the time. So anybody else have questions?
Hi, hi, good day, everyone. It mightn't be exactly on topic, but I was just curious. I know you'll mention the probability of people who may be delinquent in their payments, but I guess there may be factors that happen in their lives that affect their ability to keep that up. So, like the pandemic, for instance. So I wonder, this actually might even be a question for the bank stuff, because I wonder if the bank has any way for someone to ahead of time actually state that their financial status has changed and may have to come to the table and renegotiate their repayment. I wonder if you have ever considered something like that.
Yeah, so what I can say from that perspective is yes, that's what the moratoriums are, right? So the moratoriums are supposed to be like deferred payments due to like excruciating circumstances. So like they give like deferrals on payments or like lowered amounts of payment or the extension of the loan period, for example. So these moratorium or grace periods are what they do. People who subscribe to the moratoriums are the ones that you can assume that are impacted, right? Right off the bat, customers aren't required to like submit proof because everybody then could then therefore sign up for the moratorium, and it is a smarter thing to do, right? In excruciating circumstances like the pandemic. So yes, things like this are factored in. But let's say it was a case where it was more personal than something external, like to the customer, for example, like unforeseen job loss. I would assume then, therefore, one of the things that we have to kind of build into this model is like a correction factor, because unless a customer is able to go therefore and like update their information real time, then we will be modeling the data incorrectly because we would have been using, let's say 20,000 as their income when in reality now it's zero, right? So which could have contributed to these delinquencies. Delinquencies don't automatically mean default. That kind of is determined by the number of delinquencies. So let's say you missed one payment or you were late on a payment. That doesn't mean you defaulted on the loan, right? It just means that you were late on that payment and you can recover. The bank will try to minimize collateral loss on all cases, meaning that they would try to make back as much money as possible before writing somebody off. So default is usually something that a customer has to do repeatedly, like let's say 3 consecutive delinquent payments, then this customer could become a defaulted customer. So to answer your question, yes, there are things that can be done from an external standpoint, like moratoriums, but for more personal reasons, yeah, we would have to implement some kind of correction factor to be able to model that in this. But as of right now, it will have some flaws if no correction factor is implemented.
Okay, awesome. Thank you.
Kevan, just curious about any regulations in this area. So I guess the bank is free to just deny anybody a loan without even giving a reason, right? I mean,
yeah, for now. But like in the US, for example, they can't. Like the bank actually has to provide a reason to the customer. So like right now in Trinidad, because it's not regulated at that from central bank standpoint, they can institutions can get away without providing a reason, but like it's more rigid in the States, for example, that a reason has to be provided, like a credit score wasn't met, and that's why credit scores are super important, like in the US, and it's now becoming like a thing here in Trinidad. But yeah, right now you can turn away someone without having any kind of legal ramifications as to why.
So yeah, that's an interesting thing. The credit score. So is some companies starting to work on doing that for banks locally, or?
Yeah, there is the credit bureau in Trinidad right now that, so for example, if tomorrow you decide to go and take a loan, usually the financial institution charges you like a credit score fee, right? Like they go and run this with the TransUnion that consolidates all the loan information or mortgage information in the country for all customers across all banks. All financial institutions have to submit that to this TransUnion bureau. And then they would provide that information back to the financial institution in terms of this person has any default on loans or mortgage history, and that kind of is our quote unquote credit bureau. However, there's a lot of flaws there. Like it's not real time. Like it's usually delayed, so it's like a 1 to 2 day lag. So if you had a person like you needed a loan right away and you like needed something to happen like immediately, then there's a 1 to 2 day lag, between this TransUnion and the financial institution. So there are limitations, but it does exist, yes.
So is that a government-run organization, that TransUnion?
Central bank oversees TransUnion, so yes.
Okay, interesting.
I need to confirm though. Let me not say yes and they are, because I just know they're regulated by central bank. I don't know if like it's government owned or private owned, so I'll have to confirm that.
Okay.
Yeah, there is a body that does that, and they do report into the central bank. I just don't know if they're government owned or private.
Okay.
But if I can, like that would be some like a data. So the thing is, like if I wanted if access to that data, you have to pay for it. Like financial institutions would have to pay like a recurring fee to access the TransUnion data, like bulks of it. So like if I wanted to feed credit scores, information on customers into like my model, the organization would incur a cost to access that data. But I think it's just a small fee that they do charge because to update their systems and stuff and feed that. I don't like, it's not exorbitant, but it is something that I can consider into the model. But the organization would have to pay money for me to get access to that data often.
Well, yeah, well, because you will have the cold start problem, right? I mean,
yeah,
you're doing stuff based on existing customers, but yeah, when you have new customers, yeah, that cold start issue.
Yeah.
Actually, that came up in something else we did recent. Oh, the stuff Carisha was working on, right? Carisha with was it you that the one of the comments was a cold start, right?
Yeah, that was one of the comments.